Hello. In this video, I'm going to discuss budget planning and risk assessment in a more practical, demonstrative approach. I'm going to show you two different budgets with two different approaches. One considered high risk, the other one considered low risk. Now, for the prefix and context of this process, I'm using the same exact recipe. That is the one-hit wonder. Well, almost one-hit wonder. And I have a second recipe that works just as well for one position at a time that I will be releasing in the future after more testing. But for the context of this video, the purpose here is to show a practical way of growing your account with two different budgets, one coin at a time, using nearly identical outcomes but vastly different approaches. The left-hand side, colored in the light red, is the aggressive, more high-risk approach. Column A is the actual budget. So I'm starting with $21.50. That's it. The right-hand side, with the green, is the proper way of trading, with minimal risk, low risk assessment, proper mitigation techniques, proper management of your budget. But it requires $1,000. One position, using 2% of the account for each trade. So let's talk about these two approaches, because as you can see, they are vastly different. Now, this is a compounding algorithm, so that each successful profit is added into the next trade. So over time, these will grow. But as you can see, the more aggressive approach grows quicker than the proper approach, with proper risk assessment, mitigation, and proper budget usage. The aggressive approach commits 93% of its budget to one single position. This is akin to lump sum investing. It's profitable with the right recipe, but the risks are 93% exposure of your budget. Now, for a low account, that's not very much, $20, big deal. But of course, if you were to take this up to $1,000 or $2,000 or $3,000, then that 93% position size takes on a whole different level. Whereas over here, column G, $1,000 budget, 2% of your maximum budget, or $20. Columns D and J are the same, which is your take profit. And as you can see, column K and E, those are the actual profits you would receive at 2% of your position size. Notice that it doesn't really pick up all that quickly on column K, versus column E really picks up quite a bit. and you begin to see the difference between E and K, between aggressive and conservative. The green section is considered conservative because you're not risking your entire budget or a large lump sum of your budget. You're taking a slow, steady approach, risking only very limited amounts. Now, if this was a stop-loss based situation, then the right-hand side is really the only way you want to go. But in context of Jackrabbit being an accumulation situation, accumulation being naturally bullish that the market will always recover to the point of a profit, it becomes a wash in terms of which one is best, because they both will work well in an accumulation situation where you're not taking losses, only waiting for market recovery. But let's take a look, though, at what would happen if we use the same kind of budget from column G in column A. As you can see, column C versus column I, the exposure is a lot more drastic. But if you look at columns E and columns K, the rewards are equally as drastic. So this is a clear case of risk versus reward. Is the risk of one single position in a bullish accumulation recovery state worth the exposure? Realistically, only you can really answer that question. At some point, if you start out with an aggressive approach on a small budget, you can always switch to a non-aggressive approach as your budget begins to really take shape. So you can use the best of both worlds and just watch it properly. So let's start here. $20. Our budget exposure is $18.60. Let's move up to $50. Our budget exposure is $46.50. Our profits are, well, not that great, but they're better than 2% of the budget at $1,000. Let's move up to $100 positions. Well, it's starting to get there, and as you can see by the 9th trade, we're making $1 a position profit. That's pretty good considering, but this is only still one position at a time. So, that begs the question, which is better? Well, here, left-hand side, one position at a time. Over here, a $1,000 budget, one position at a time, or you could use aggregation and trade 10 coins at once. A 2% balance per position, or a 2% of your budget. So $20 by 10 coins, you have a total exposure of $200. And you're making roughly $2 in profit. So aggregation for the $1,000 budget can help make more money in the long run, but Again, you have increased your exposure to $200. So, are you gaining or losing in context of what you're trying to do? If you have $1,000 and you simply take on more positions to accumulate quicker versus taking on a higher position size to accumulate quicker. Here's the problem that really has to be addressed. In a stock market, you don't have dominance between different stocks, usually. In the crypto market, dominance is a heavy factor, so when Bitcoin or Ethereum drop in price, typically so does a large number of other coins on the market. So if you have one coin that drops, you only have to deal with one coin using the left-hand side of the chart. But if you have 20 coins and they all drop, then you have more exposure and more risk. So your trade-offs become problematic. Which one will be better in the long run in terms of risk mitigation? Does aggregation actually limit your risk, or does it increase your risk? Well, anytime you have to evaluate risk versus reward, these are the things you must consider. Realistically, if you have a good, solid performing recipe with an asset you believe will recover, whether it's Bitcoin, Ethereum, XRP, LTC, it really doesn't matter. Any coin above 1 billion market cap should be stable enough to use both of these principles. The determining factor to this process is you. Can you handle $930 in one position in a market like we've had for the last several months, with today being absolute insanity for market prices? That's the big question. So here, one position, $900. Here, 10 positions for a total of $200. Here, $9 profit versus $2 profit. Let's take this down to something reasonable. Let's say we want 20%. So that puts us at $2 and a risk exposure of $200. Comparable with the right side conservative. So 20 positions on the right, one position on the left with 20% budget. Which way works best for your risk assessment, or are they really both the same? For the crypto market, the argument needs to be made that to some degree and context, both of these sides are actually the same. It's just a matter of you and how you evaluate your personal risk. The more aggressive people are going to want to go all in, lump sum, and they're going to really want to, what am I doing? They're going to really want to maximize their leverage. One coin, one asset, maximize it extensively. Now I chose 1% for the take profit because that's reasonably accomplishable in a short amount of time. So your recipe is likely to make a trade a day or a trade every couple of days. So you have high frequency to sustain both sides. Even if you prefer a more conservative or slower approach, you're still going to do reasonably well by the end of the month. You may or may not make your break-even point depending upon your risks, at least on the right side. The left side, you're looking at X number of trades. You can easily see that this could make a break-even point reasonably well. So, how do you address profitability? How do you address the big question? Aggressive versus conservative. The aggressive side has its options. The conservative side has its options. Each have advantages, each have disadvantages. Your budget will play a major factor. You play the biggest factor. Now, if you use an accumulation approach, do not use the left-hand side. It only works when you're using a one-position recipe, like the ones I've demonstrated or the countless others that YouTube is filled with. And there are a lot of different combinations that only rely on one single position. Whether it's MACD or Bollinger's, it doesn't matter. All that matters is that you have one lump sum position. Now, the one thing I want to explain here, why am I only using 93% versus using 100%? Well, that is because of market fluctuations. I want to be able to maintain fees and fluctuation leadway within the account. I don't want to end up in a situation where the entire account is consumed without any way of paying fees or handling some of the market drops we've had recently. So I'm using only 93% as my highest point. If you wanted to take on more risk, you could probably use 95 or 97%, but I personally don't know if the risk versus reward is worth that elevated level, because your reward is not going to change significant enough versus the magnitude of risk you take on. So, from the standpoint of your trading, only you can make the determination of which one is best. Because really, if done properly, they're actually both identical. And that all right, helps if I type right. That really is the whole point of this chart. You could achieve the very same thing aggressively or conservatively. It just depends on you and your budget. Hopefully this will help provide some insight into your investing and how you can actually take a small budget and leverage it against a larger budget, even though you have slightly higher risks. Balance is the key. At some point, you're going to want to take the aggressive side and migrate it to the more conservative or defensive side. So once you figure out your balance and you figure out your trading plan and how you want to approach, you have a rounded approach to grow your account from any size to a large size. The one thing you don't know is how long it will take. That's the only given. These trades could take place once an hour, once a day, or once a month. So if you have once a month, it becomes questionable whether or not a defensive approach is better versus an aggressive approach that will quickly give you a way of managing your risks for very small budgets. Think about your overhead, because that also decides which approach you're going to want to use. If you have, say, $30 a month in overhead, and you only have a $100 budget, you're going to want to use a more aggressive approach to be able to build quickly to break even. And in this case, as you can see, over the 30 days, you are likely to break even here. Although a $200 budget would be more comfortable, because then you can clearly see the break-even point using lump sum capabilities. For your $1,000 defensive budget, your break-even point is going to be difficult because you're not using that much of your account unless you use aggregation. So if you have 20 coins trading with only 2% budget, or excuse me, 10 coins with only 2% budget, or $200, then you're likely to break even there too. But again, balancing it out, coin choices. The right-hand side, you can take on more riskier coins that might provide better liquidity and volatility. The left-hand side, you're going to want to stay with coins that are very stable, high market cap value, because you can't afford to take too many risks with such a extreme aggressiveness. If you have any questions, leave them below in the comments section or put them on the Jackrabbit support server and let me know. Like, share, subscribe if you're not. Until next time.